Good afternoon and welcome to Nasdaq Sector Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Adam Lazaris. He's a transportation sector analyst. Good afternoon and welcome to Nasdaq Sector Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Adam Lazaris. He's a transportation sector analyst with Nasdaq IR Intelligence. Adam, it's great to have you back with us at MarketSite. And some of our viewers may not know we have over 50 analysts on your team. What do you focus on specifically?
Okay, so my last name is actually Lazarus.
Oh, Lazarus, okay.
No worries. So I concentrate mainly on the transportation team, which falls under industrials, of course, and transports is very broad. It covers the airlines, it covers shippers, it covers truckers and railroads.
Right, well, it's so key with your sector because your sector really is a barometer for the American and global economy. So we get a lot of clues out of what you guys are looking at. Let's talk about some of the areas within transports. Dow Theory is something that you look at.
Yes, so Dow Theory is a 100-year-old theory that basically looks at the Dow Jones Transportation Average and the Dow Jones Industrial Average. If there's a divergence in the transports from the industrials, it could signal that we're going to have a new high or a pullback. And the reason behind it is for transports, if you're going to ship or put on a boat, put on a train, put on a plane, it's the raw goods are already finished and they're being delivered to the stores. Compared to the industrials, they're recording the actual sale, which could happen weeks later. So if there are fewer goods being shipped over, we would see a divergence, and that's when we can tell when there might be a pullback or a new record high, which back in 2014, the transports are hitting new highs almost every day, and the industrials, within a reasonable time, were hitting new highs every day also.
Right, now what about the Baltic Dry Index? What do you look for there?
Okay, so the Baltic Dry Index is basically how much it costs to rent, say, a big cargo ship to transport finished goods from factories in China to the port of Los Angeles. Now, so far to start at least 2018, it's now down at a 2.5-year low, and it's having its worst start to the year since 2014. So far, we're not seeing shippers really have hit record lows, at least, or are pulling back. They've already recovered from the December lows with the broader markets and are also trading roughly where they were at the beginning of December, at least for shippers.
Right. So when you see that 2.5-year low, what does that indicate about the economy? It sounds like less goods and services are moving back and forth.
It does. You would think that, and with potential tariffs or tariffs already in place and potential for more, we would see a pullback in the shippers. But so far that hasn't happened. Even though it is a bearish signal, we're still just going to have to keep an eye on that. The divergence has not happened yet, but at least the signal is there.
Right.
We're seeing other signals around for air freight or for truckers. We're seeing some bearish sentiment regarding Amazon as they use them to outsource the last mile delivery for a lot of their business. And now Amazon may be taking that in-house. So instead of it being a revenue stream, they're now in direct competition with Amazon, which is another bearish signal for the transports in general. But if you look at the index, you're seeing right now, steady as she goes, it's off the lows from back in December, which they fell more than the industrials over that 3-week span because of rising interest rates, concerns about tariffs, and concerns about earnings, at least for this quarter, which didn't seem to pan out. But right now, there's bearish signals, but we haven't seen the divergence yet from the industrials average.
All right, now what about the airlines? They seem to be performing pretty well.
The airlines have been performing well to start the year, even with the government shutdown, with the FAA and TSA, with them not getting paid. It was basically business as usual, and the airlines are taking advantage of the low oil prices because a third of their expenses is just buying the gas. So for having lower oil prices for an extended period of time, that's going to help the airlines. And also that unemployment is roughly around 4%. So that does help that more people are flying, businesses are still flying. And sort of the shutdown almost ended when we had trouble at LaGuardia and Newark when their FAA staff didn't show up to work, but since it was so short-lived, it didn't really affect them in their stock price.
All right, now let's wrap it up with trucking and freight. And you touched on this momentarily regarding Amazon, but what do you see overall?
Okay, so right now, yes, there are at least bearish signals. We're seeing at least, I mean, of course, Amazon's the behemoth in the room that we don't know what's going to happen. But if they start taking things in-house and they're more of a competitor to some of the bellwethers that we have for the sector, we could see a pullback. It's just tough to determine how much of their business, especially like we have right now, they use a lot for last-minute delivery. Until they get their warehouses in place and they get the logistics behind it, which the logistics companies have been using it, or Amazon's been using them. When they start pulling back, then we could see potential bearish signals, at least for that. But right now, it seems to be going steady as she goes.
All right, so overall, when we look at those 4 different metrics that you use as a transportation analyst, how do you feel from a macro perspective?
Well, from a macro perspective, yes, they are bearish. We could wait to see what happens March 1st with the tariffs with China, which you could see a potential slowdown in however many products are being shipped. There is also the thought that they may just change their logistics and go to other countries to get around the tariffs, which we may be seeing part of that, or bringing it onshore. So that also is bearish, because if you're not having to ship it, you're all bringing it in-house or in the country. That's a negative for the sector, because now there's no place to ship it. It's just a last mile delivery.
All right, Adam, thank you so much for the insight. We look forward to catching up with you in March after we pass that March 1st deadline.
Absolutely, looking forward to it.
All right, thank you so much. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.